Hi, I'm Eric.
And I'm Dick. We're the Annuity guys.
Now, Dick, there are so many different kinds of annuities out there. What, 31 flavors if you get them at Baskin Robbins?
There's a lot of annuities, but you really get down to, Eric, there's really just two real categories of annuities, and that's your fixed annuity and your variable annuity.
Ah, the variable annuity. So maybe that should be a great choice for talking about this week. So what is a variable annuity?
Well, we use the words VA a lot, and that's thrown around in the industry.
And
we don't want to.
It doesn't want to be Veterans Administration. So,
yeah, we don't want to confuse that with the Veterans Administration.
That's right.
So a VA is an annuity where you want to have a higher upside potential. So you're willing to take investment risk.
It's not an insurance product?
Well, it is an insurance product. It's a cross between a security and an insurance product.
Okay, so it has, so when we're talking about the security side, it's really kind of a insurance wrapper around a series of mutual funds or equity investment options like.
Well, today's VAs, Eric, go so many directions in the investment sub-accounts. There's, depending on the company that's offering it, some of them have a very, very vast array of investments. Some are very, very narrow and restricted. So this is something that folks really need to look into before they choose that VA, because a lot of times they're told, well, you've got that unlimited upside, and also we always talk about you got that corresponding
downside,
unlimited downside, or limited to the loss of your principal.
And that really is the key difference when we're talking about the difference between a fixed annuity and a variable annuity. On a variable annuity, usually there's no caps or no participation. You get 100% of the participation.
Yes.
On both the upside and the downside. So your principal is somewhat at risk.
Well, very at risk.
Well,
completely at risk.
I always try to hedge a little bit. So that is, you're making the investment choices versus the insurance company. So you're responsible typically for picking the mutual funds or exchange-traded funds.
And the opposite, which is where you're going with
Right.
this, I'm sure, is that the fixed annuity is completely guaranteed, and the risk is all assumed by the company that's offering the fixed annuity. And that's what separates a VA from a fixed. The VA is considered a security, at least to that degree, and the fixed annuity is a fixed product which offers safety and guarantees.
So it's principal protection.
Yes.
Insurance companies
Yes.
making the investment choices.
Yes.
All right. So who should be choosing a variable annuity? Is there a particular type of individual that perhaps a VA might work better for?
Well, if you're a VA salesman, everybody needs a variable annuity.
If the only type of annuity you offer is a variable annuity, then everybody
needs one. However, there really are those folks that can benefit from a variable annuity, and the ones that we've spoken to, and clients that we've had that have had VAs, the ones that they really fit tend to be on the younger scale. Maybe I'll go as low as in the 20s,
Sure.
up until maybe the early 50s. And their reasoning for this, and we could also extend that for certain reasons for others that are older. But the real reason that folks tend to choose these is because they want that unlimited upside, and they want to avoid tax. They want to avoid capital gains tax when they move from one investment to another. So within this variable annuity wrapper, they can defer all of their tax and just keep trading and moving things around.
Still a tax-deferred vehicle. It can be, you're right. Typically, younger people who are in their accumulation years, they're accumulating dollars for future spending. So typically retirement.
Yes.
So, a tax-advantaged wrapper. People that have maxed out their contributions to their IRAs or their 401ks. Well, if you're still looking for that tax deferral, an annuity, a variable annuity, if you're in the accumulation stage, maybe one of the options that you can consider.
Yeah, so you really have to be less risk averse, more interested in market growth, and then you have to be wary of the fees.
Yeah.
Because there's ways you can get variable annuities with extremely low fees, but the majority that are sold they're just the opposite.
Well,
they have the very high fees.
Most annuities are sold on the sizzle, as we say. I'm. It's always wonderful when you look and say, "Hey, got a 6% guaranteed annual daily ratchet." So wherever your high point is, we're going to add this, or and you got guaranteed income for life. All these pieces can be added on to a variable annuity. That makes it sound like, oh my gosh, I can't look. How can everybody not be purchasing a VA? Well, what they don't go out and say, for that 5% guaranteed roll up, you're going to pay another 2% every year. And oh, by the way, that 5% can only be used for income for life. If you want to walk away with
it's
cash,
not a true 5% growth of your account, right?
That's not what they told me.
That's not what you understood,
right? That's and so the fees are always part of what we have to talk about when we look at a VA and whether or not it's the right vehicle. Almost. They all have a mortality and expense fee, I think, is what makes that kind of that base wrappy.
Right, that chassis of the variable annuity.
And the very low cost kind of brokerage house ones are very small. I mean, it might be a couple 20, 30 basis points.
Yes, below 0.5%. And so folks can go this way if they really want those benefits of a variable annuity and a very low cost way to do it. I hate to mention names, but the big brokerage houses, Fidelity, Vanguard, these types, they offer those, and they're very, very low fee. Now, on the other hand, if you want the guarantees, I mean the real serious living benefits, and we do have to go back in history and say that it was the variable annuity that got this started on the living benefits, and then those transferred over into the fixed annuities and the hybrid style, the indexed annuities, and so now if you want those benefits, you don't have to have a VA to get those.
No, you can get them through the fixed world. The income riders are now attached to almost every type of annuity. Now, if you're looking for that market participation, but you want that kind of guaranteed income for life, a VA with an income rider can do that. Now, there's always the caveat there. They're going to take their fee out every year, or actually probably every month is what's coming out. And so you're paying that. For that 5% income guarantee, you may be paying them
3 to 5%. When you put all the fees together.
And so we always say you have to look at when you're starting to take those withdrawals, be careful because they may be paying you 5%, but if they're taking another 5% for your principal balance to still continue to be increasing, you have to be hitting a pretty consistent 8 to 10 to 12%.
And even when the market is dropping dramatically, they're still pulling that 3 or 4 or 5% out of your account.
They get their money.
Their money comes out first. Yes. So really, again, just as a general thought on this, for those folks that really want it for the pure investment aspect, consider the no load or the very small load.
No riders.
No riders. And keep your fees on the low side and get a wide array of investment choices.
Yes, I was going to say there's up to 300 in some of these VAs. So it's definitely a good option for people looking for accumulation and still in that phase where they can grow.
It tends to be for the younger person.
Yeah. So is a VA a good choice for some?
I believe it is, Eric, and you just have to weigh your own situation.